All right. So I'm a software developer or software engineer here at TransferWise. We're going to have the slides up in a second. Full screen, yeah. Cool. So I'm going to talk a bit about risk or currency risk at TransferWise. So my talk is going to be a bit more about finance and less about technology this time. But the next talk that we're going to have is more about tech. All right, so first, how does TransferWise work? Like, this is the simplest model. So let's say we have a person who wants to send £1,000 to the Eurozone. And let's say the exchange rate is exactly 2.0. So on the other end, he wants to receive 2,000 euros. So what they do a local transfer in the UK for £1,000. And we do a local transfer in the Eurozone to their recipient for 2,000 euros. So what do you think? What could actually go wrong here? Or what are the risks here? What could happen if we do this for a long time? Does anyone have any ideas?
You run out of money, right?
Yeah, you run out of money. So essentially the idea is that if it's fully peer-to-peer, then these buckets are balanced, right? So to be fully peer-to-peer, we would need another person in the Eurozone trying to transfer 2,000 euros to the UK. So in this case, they would exactly balance each other out, and we can match those transfers, and there's no problem. All right. So, but the reality is that there's never like a fully balanced currency route. There's always more people in the UK trying to send money to the Eurozone than vice versa. So what do we do then? We have to move liquidity. Our GBP bucket will be larger at some point, so we just transfer some money over to the Euro account. But this means we need to go on the foreign exchange market and actually buy this currency, right? And let's say we buy it for, I don't know, 1.9, and then we sell it to the customer for 2.0, which essentially means that we lost some money, right? Okay, so let's define currency risk. So what does it actually mean? So it means that if TransferWise is set up in the UK, our home currency is the British pound, and in case we have any other currencies other than the British pound, let's say we hold some euros or we hold some USD, then this is risky for us. If the exchange rate goes down or if the exchange rate goes up, it means that we could either win or lose some money. So we don't want to bear that risk. All right, so what is a hedge? A hedge is essentially just any type of trade or instrument that you use to get rid of that risk. And what is a short? A short selling is essentially that you borrow something from someone else and then you sell it off to the market. So if you short, let's say 1,000 euros, then you would borrow this money from the bank, then sell it to the market, and let's say get some pounds for that. Okay, cool. Now let's look at some graphs. This is what the economists really love. So the axis here, yeah, we have a laser pointer. So on this axis we have the euro to GBP exchange rate, which essentially means that how many euros you get per £1. So if it's 2, then you get 2 euros for £1. And this is payoff. It's just either profit or loss. If you go up, it's going to be profit. If you go down, it's going to be loss. Okay, so now let's say we buy £1,000 for 2,000 euros. So this means the exchange rate is exactly 2.0, right? We're here. And we go a long position. That's something that the finance people call a long position. All right, so what does it mean? Why does the graph look like this? So let's say that the exchange rate goes up. The exchange rate goes to 3. What happens then? If it goes to 3, then this £1,000 that we bought earlier is now actually worth 3,000 euros on the market if we would want to sell it. Therefore, our payoff or profit would be 1,000 euros. Now, what happens if the rate goes down? Pretty much just the opposite. The rate goes to 1, then we would lose 1,000 euros, right? Okay, so now let's clear this and let's draw the same graph for a short. This is the short position. So now we sell 1,000 pounds for 2,000 euros on the market. And this is a short position because we don't really have these pounds. We borrowed them from the bank. So the exchange rate as of now is 2.0. Now, what happens if it goes down? As you can see from here, this 1,000 pounds is now worth 1,000 euros on the market. So essentially what we could do is that we go on the market, we buy back the pounds that we borrowed from the bank originally, and we pay back our loan. And if we pay it back, then essentially we got 2,000 euros for this at first. Now we only spent 1,000 to buy it back. So we're in the profit side. We're in the plus side with 1,000 euros, right? And it's the opposite here. So if the exchange rate goes up, we lose 1,000 euros. Because this is now worth more than we originally paid for it, right? So now what happens if we do a long position and a short position at once, at the very same time, at the same exchange rate? Right, these are the two graphs combined. So essentially what happens is that if the exchange rate goes up, the long position will earn us 1,000 euros, but the short position will lose us 1,000 euros. So essentially we're here in the zero, right? And this is, yeah?
Probably, except for some commission you pay your bank, that you lose it either way.
Yeah, exactly. I mean, if you borrow money, you have to pay some interest and so on. But I mean, let's make some assumptions here, and there are no commission fees, just for simplicity's sake, right? So, yeah, this is the sum graph. I'm going to go back for a sec so you can see the difference. Essentially, whatever happens with the exchange rate, we're always just going to be at zero. We're never going to earn money. We're never going to lose money, right? So how do we actually do this in the real life? It's a very simple example. So let's say we have one bank account in the UK. So this is the Barclays bank account. And we have another bank account in Estonia, which is LHV. So now, let's say it's Monday. And currently, the exchange rate is 2.0. So for £1, you get 2 euros. Now, let's say that our LHV bank account is totally empty. There's nothing in there. It's 0 euros. Now, we want to move some liquidity there. We want to move some euros there. So if someone would want to send money to Europe, we would actually have that money already there to do that local transfer, right? So how much euros do we get here if we do this exchange right now when the rate is 2.0? 2,000, right? Okay, I'm just checking if you're listening. All right, so we get 2,000 euros. Now, what I said earlier is that if we hold any other currency other than the pound, we're basically taking on some risk. If something happens to this exchange rate, if this goes down or up, we're gonna either win or lose some money. You know, let's say, as of now, if we wanna trade this back to pounds, we're gonna get exactly 1,000 pounds. But let's say the exchange rate went up, like 2.1. How many pounds would we get? We would get like 2,000 divided by 2.1, right? Which is less than 1,000 pounds. So essentially, we would lose some money, right? Okay, so let's go on. So how do we protect ourselves from holding these euros? Let's say we have another bank account in the US. Let's say Goldman Sachs. And if we go long here with 2,000 euros, we need to go short with 2,000 euros too, right? To make sure that it balances out. So we borrow 2,000 euros from Goldman Sachs, we go on the market and we sell it. And we get exactly 1,000 pounds for that. So this is the balance that we have in Goldman Sachs as of now. All right, now let's say it's Tuesday. And now the rate increases. Now it's 2.1 euros per 1 GBP, British pound. And now, let's say we have a customer. Customer is king, right? With hat and all. And they want to send some pounds to the Eurozone, let's say a girl, right? Some euros. So what they do is that they take £1,000 and they do a local bank transfer to our Barclays account. And now we take, since the rate is 2.1, this is the mid-market rate at the time, we promise them that we will pay them 2,100 euros. But we don't really have that. We have 2,000 in LHV. So essentially, this account will go into negative. We have a loss here because we bought these euros for this rate, but we promised our customer a better rate. So we got a loss here, right? So now, how do we get rid of this loss? We have this hedge set up here, right? So let's go to the Goldman Sachs account and let's close this hedge position. So now we can go on the market and take our £1,000 that we have on this account and we can exchange it back to euros. And since the rate is 2.1, we would get 2,100 euros for this, right? So this is the pounds that we sell. So the hedge will go to 0. And this is the amount that we borrowed initially. But now, since we sold it on the market with a better rate, we got 2,100 euros. And if you take the difference, this is an upside of 100 euros. Right. So if you sum these two up, it's exactly 0 euros. So whatever happens with the exchange rate, we're never going to take on any risk here, right? So this is, of course, it's simplistic. It's you have to pay some commission, you borrow money, and so on. But we also charge our customers. We charge our customers, let's say, 0.5% fee. So we can just cover that. We use that fee to do the hedge. And the hedge shorts are super. Yes.
What if the exchange rate in different banks differs?
It's the market rate, let's say. I mean, if you go on the foreign exchange market, there shouldn't be a huge difference. If there's a huge difference, then there's arbitrage opportunity. You could just have two bank accounts, you know, sell on one, buy on another, and then profit the difference. And since there are arbiters or people doing this all over the world, I mean, anywhere, like just high-frequency trading computers, if they see a difference somewhere, they're going to just arbitrage it away. So the exchange rate is always one. That's like, if there are so many laws in physics, there's only one law in finance, and that's the law of one price. Loop.
Okay.
Right. So you can just play around with this, and you could say that, okay, let's say what happens if the rate goes down, let's say 1.9, then essentially this one, we would have to pay out 1,900 euros, so we would earn 100 a year. But the short would actually get a loss, right, of 100. So it doesn't really matter. We will always be in the 0 here. And this is fine, because TransferWise doesn't really want any foreign exchange like upside. Or we could also use something like puts or something instead of a short, which essentially means that if the price goes down, then we would earn some money. But if the price goes up, then it's going to be 0. Yep.
Let's go through the situation once again when on Tuesday exchange rate actually went down to 1.0 to 1.9, sorry.
Yeah.
Then you promise the customer that you pay out 1,900 on the other side.
Yeah.
And you still got your hedge in Goldman Sachs.
Yeah.
Which currently is losing money, but since you are kind of gaining your margin or gaining your profit on the transaction between customers, why do you then have to close the hedge position? Why can't you just leave it open as it it's not the right time to close it?
I mean, yeah, that's the thing. We don't really want to time the markets or do any kind of like trading or speculate or whatever. This is not our main business. Our main business is just international money transfers. So whatever happens in the market, we don't really care, and we don't want to care. We just want 0 risk. So that's why we use shorts. You could also use puts, but they're much more expensive. You have to pay like, I don't know, 3% for that. But shorts are like essentially for free. if you do overnight shorts.
I see. Thank you.
All right, so that's about it. Any other questions?
One question was from Chris.
Yeah, Chris.
So how did you start learning about this? Why did you start learning about this?
Well, essentially, at first, the whole idea, like I said, TransferWise was peer-to-peer, right? How can I go back? So that was the initial idea, that there's always someone on the other side. So these buckets will always be balanced, and you never have to go on the foreign exchange market. So you never take on any risk. But we saw that these buckets are unbalanced, and we started moving liquidity, and then we realized that we're actually selling this liquidity to the customer with a different price, and we got some foreign exchange losses and so on, and this kind of led on. And at some point, we also worked on something called fixed rate, which essentially means that if you go on the site, you see the rate, and this is the rate that you're going to get. We guarantee it for 24 hours. So this is some extra risk for us. And when I was developing this fixed rate feature, we had to take care of all of this. There was no other way, because no one really knew how much the company would lose if we just start offering fixed rate to everyone. So we had to figure all this out to be able to release that feature.
Okay, there was another question.
Yep.
So this scheme you described, how often does that happen? Do you do it on a daily basis or a weekly basis?
Well, as of now, ideally it should be automatic, right? So it's like if money comes, if we remove liquidity, we auto hedge it. If we promise some rate to the customer, we auto close the hedge.
So you make one transaction, well, you make one hedge per transaction, or that's your goal?
Well, you move liquidities in millions, but transactions are like thousands. So essentially you open up $1 million hedge and then you just close it by the thousands.
So you close it when you have made 1 million transactions?
Well,
more or less.
yeah, I mean, just transaction amount. So someone could send like 1,000, someone could send 100,000, right? So essentially.
Does it mean you batch your customer payments to some transactions? You gather like transactions in batch and then do the transaction?
Well, essentially yes, because when we started, we were doing all of this manually. There was no like API integrations or anything. So basically, there was this one finance guy sitting in the computer and watching the graphs and saying, "Okay, now I need to set up this hedge." And then he did it every hour, and now he does it every half an hour and every 15 minutes or whatever. But I mean, it should be automated, right? So
Yes.
essentially, that's our future plan. We're not fully automated here yet, but we have the Goldman Sachs API, and we're doing the integration.
More questions?
Yeah.
Yeah, here, please.
Question. The banks usually have a problem when a lot of people go and want to take out their money in cash because they have the money used otherwise.
Yeah.
Is the same true for TransferWise? It seems like one of these bubbles could get empty and people still want to transfer the money, so...
It shouldn't be a large problem. Of course, you need some kind of liquidity buffer, given that the money, this transfer takes some time. You know, UK transfers are quite fast. They get there by a couple of hours. But if there was some other transfer from euro, then this could easily take like, I don't know, 48 hours for us to receive the money. So, of course, you need some kind of liquidity buffer. So essentially, that's one of the reasons why we're using our investors' money to keep the engine running. So we need some extra buffer for that. But if all these payments would be instant, then you don't really need any buffer.
Artyom,
As far as I understand, you're positioning yourself like wise transfer, so you don't transfer money between banks, but so you kind of sell the currency in one and then buy in another, right?
I'm not sure I understand.
Okay, let's say you don't use pounds, you use dollars. Can I transfer dollars in UK to Barclays? what will you do it then? Will it then, if you want to transfer to euro?
Incoming payments, I think we even accept other currencies, but outgoing, I'm not sure. I think if you're sending to Europe or like LHV, your Estonian bank account, then it has to be euro. You cannot really transfer dollars to an Estonian bank account.
Okay, let's say I have euro in UK, and I want to send euro in Estonia. How will you handle it then?
We have the same currency transfers also, functionally ready, or like it's a hidden feature. Or let's say all our internal employees can do euro to euro transfers or pound to pound transfers, but it's.
I mean, do you sell euros, buy some currency, and then buy euros back in another bank, or do you still use bank-to-bank transfers?
I think the question is whether or not you hedge same currency transfers.
Well, basically, we need to hedge anything that is not GBP. If we hold some kind of a position in euro or USD or whatever currency, then we need to hedge it. But the problem is that in Goldman Sachs you can only hedge like the major currencies. If you want to try like Nigerian Naira or something, then it's probably not supported. So there's a problem there.
Okay, question was on the second row.
Recently I've made a transfer with TransferWise, and I've noticed one thing, that on the last step it was offering me quite hard to use a credit card instead of bank transfer. Is it more profitable for you to use credit cards? Because my initial plan was to use bank transfer, but it was advertising like it will take 5 days for the bank transfer. If you use credit card, it will be like instant. So like pushing to use it.
Yeah, it basically depends on the partners. We're partnering with IDN as of now. Maybe we're gonna have some more credit card and debit card partners. So it just really depends on our partners. Bank transfers just are historically slower. I don't know why, but IDN payments just get there instantly. We receive the money right when you press submit. Yep.
Okay.
Yeah, how many currencies do you handle, and all are these balanced by long and short time?
Basically, all the major currencies that are supported by Goldman Sachs. These are the ones that we hedge, and all the small ones, like I don't know, South America, maybe Turkish lira, Russian ruble, so on. Those we don't really hedge, so there's some risk there. But I mean, you also have to consider that it's also upside risk, not only downside risk. So sometimes we just earn some money because the rate went up, or vice versa.
The main transactions go with pounds and euro, right?
I think, yeah, the major currency route is euro and pound. I'm not even sure which way is it right now. I think it's more or less balanced. The USD route is also quite big, and also Australia. Yeah.
Sorry, first was this guy.
But isn't your biggest risk fraud?
Yes, and we have some fraud guys here, right? So
I would say anti-fraud guys.
yeah. So yeah, the next talk is going to be about the fraud engine, right? So they're going to talk a bit about that.
One question was over there.
You made a transfer from Barclays to LHV.
Yeah.
For example, what service do you use for doing that?
I think it's a regular SEPA payment or something. I don't know. I mean, we don't really do this in reality because I think these routes are balanced, more or less. So we don't need to move a lot of liquidity between those currencies. But this is just an example.
You have mentioned that your major currency is currently pounds. Have you considered bitcoins as your liquidity?
Yeah, but it's complicated. It's not very highly regulated, and we're a financial institution, so we need.
You're not looking into the blockchain market.
We are, but it's in a way it's complicated. We're just waiting to see what happens with that technology. We have some people who are super excited about it, but overall, as a company, I think we're a bit more conservative on that side.
I would add that it's a very small market. Like your money is
Do you have any legal obstacles regarding Bitcoin and blockchain?
I don't know. We have other people who know a lot about this. I guess Martin Sock is not here.
It makes partners nervous.
Okay.
Put it that way.
Well, any more questions? All that clear. Well, I have one question I'd like to ask myself.
Yep.
In case that do you support payments that are distributed to multiple recipients, or do you count it as just multiple payments?
That's a good question. I think the regular flow is not to multiple recipients, but there are some other corner cases. Like for example, if you want to send like £1 million, but your bank won't allow you to send that at once. So you can send it in batches. Like every day you do a 100K transfer to us, and do it 10 days in a row, and then we batch it all up and send it out. So I mean, there are some flows like this, but multiple recipients, I'm not sure. I mean, it's probably possible if you call our CS and ask the ladies to split the payment or whatever. It could be possible.
My initial question was that in case this is the case, and then the payment is taken in multiple parts in multiple currencies, how is it then hedged? It's like each transaction is hedged like a pair of currencies separately, or?
I'm not sure. I mean, you mean you send like £1,000, but you wanna send out like some euros and some USD and some.
For example, I sent money to multiple recipients at once. One is in Europe and operates with euros. One is in Russian, operates with rubles, and third one is elsewhere, operates with third currency or fourth currency.
Okay, but do you do one transfer, like one currency, or you just?
Yeah, from pounds to euro to rubles and else currency. So then in this case, these are all separate transactions.
Yeah, essentially.
Okay.
Yeah. All right, I think we're out of time. Thanks.
Thank you.